This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
The only area that still remains to be done here within Chapter 6, dealing with the unincorporated trader, is, as you can see here, Section 3, the cash basis for small businesses. Now, this area has not changed for a number of years. The system is exactly the same as it has always been. That is why the rest of the lecture that deals with this particular section is taken from Finance Act 17. Don't need to worry about the fact that that's a couple of years old. Some of the financial management and financial reporting lectures you were seeing will be a lot older than that, I would suspect. But in relation to this area, there's no change. So other than there's a couple of examples where it doesn't matter, but the dates happen to have changed. All the processes, all the techniques, all the issues are exactly the same. So for the rest of this lecture, therefore, you'll be seeing the lecture, as I say, on this area, going back to Finance Act 17. There's just a brief little introduction as I finish off when this lecture cuts in from the last thing that we were looking at, which of course was dealing with the cessation of trade so far as bases of assessment and capital allowances were concerned. Okay, so for the rest of this session, I'll hand you over to myself 2 years ago, therefore enjoy that lecture. Well, as you've seen in this chapter, it's pretty much the case that in opening years, the bases of assessment are far more difficult to work out than it is in closing years. And that's going to be seen to be true now when we move on to look at capital allowances. Again, perfectly normal capital allowance computations will be prepared all the way through to the penultimate, the one before last, the penultimate accounting period. And then it's the final period of trading for which the capital allowance computation must be prepared, and that's the one that's different. Now, I hope that you remember how we dealt with that in Chapter 5, where, as it says here in your note now, at the top of, well, halfway down there, page 45, on cessation of trading, all your normal stuff goes. There is no writing down allowance, there's no AIA, there's no FYA. None of those are available in the final period of trading. And all we do is to compute final balancing adjustments on cessation, where we deduct the sales proceeds from the then tax written down value. Now, that might have to be repeated 2 or 3 times over. We may have the main pool, the special rate pool. You may have a non-pool assets. On each of those categories, we deduct the proceeds from the tax written down value, and the difference that is derived is a balancing adjustment. Remember how we determined the balancing adjustments and what we would do with them. If the proceeds were bigger than the tax written down value, it created a balancing charge. What do we do with the balancing charge? That was an addition to our profits rather than a deduction from our trading profit. If, of course, when we sold, the proceeds were less than the tax written down value, then we hadn't claimed enough allowances over the period of ownership, and that was therefore a balancing allowance. What do we do with that? Treat it like you would any other capital allowance, and you deduct it from the trading profit to again derive your tax-adjusted trading profit figure. And once you got that tax-adjusted trading profit figure, that was the figure you could then use in your assessments. As we saw earlier in this chapter, we use CYB all the way through to and including the penultimate tax year, and then every other remaining period is either 1, maximum 2, would be allocated to that final tax year's assessment, from which we then deduct any overlap profits in the form of overlap relief. It's exactly the same. All we've had to do in getting the assessment, the adjusted profit figure for the final period of trading, we've had to go through the capital allowance computation. Now, the only thing that you might see is that before you cease trading, but in that final period of trading, maybe there were some additions. Now, we've already said, if there were, then there is no AIA, there is no FYA. Equally, there's no WDA. So if we do have additions in the final period of trading, you simply add them to the relevant pool, whether it's main, whether it's special rate, or whether it's in its own pool, like an asset with private use by the proprietor, for example. We then deduct our disposal proceeds in the normal way. Remember, with proceeds, we deduct sales proceeds to a maximum of original cost. You can never take out more than you originally put into that computation. And they're deducted to find that balance. As we've just said, if that balance is still positive, that's a balancing allowance. whereas if the net balance is a negative figure, i.e. the proceeds were bigger than the tax written down value, then that's a balancing charge. Balancing charge is again added to the profit. A balancing allowance, just a normal capital allowance. Okay, now that sorts out your issues that pertain to having got a tax-adjusted trading profit, having computed and deducted the capital allowances relevant to that accounting period. We get our tax-adjusted trading profit and then allocate using the bases of assessment that we've seen in this chapter. But the profit figures that we are adjusting up for taxation purposes are the profits from our accounts. And the accounts, of course, have to be prepared on an accruals basis. Now, if we've got very small traders, little one-man businesses, as it were, very small traders, then who actually needs the accounts being prepared on the accruals basis? Who's going to use them? It's really only ever been HMRC. Accounts will be required in some form or other, maybe to show banks or other financial institutions who want to, or are required maybe, to lend money to that business. But basically, it doesn't really need to be using the accruals concept, which of course has underpinned accounting for 600 or 700 years now. So what HMRC have very sensibly done is to allow small businesses, we'll define them in a moment, to use a cash basis. Any business will have to record cash. That is the most basic of requirements for any business, to record cash. But we don't have to necessarily deal with all the accrual system. That, of course, creates the need for accountants, which is not a bad thing, of course, I would hasten to add, and it piles up the costs for these small traders. So much better, therefore, to simply get them to keep accounts of receipts and payments, and therefore to work the profit on a cash basis rather than accruals basis. Simpler, less expensive, seems like a good idea. So how does this work? Right, here again, looking at our page now in section 3, cash basis for small businesses. Now it says certain small unincorporated businesses. Now, unincorporated, we know, either a sole trader or a partnership indeed. We'll define exactly which small businesses we're talking about in just a moment's time. But if they qualify, then they elect to use a cash basis to determine their tax-adjusted trading profits instead of the normal accruals basis. Now again, as we'll see, we'll still have to go about our normal adjustment of profit for taxation purposes. If something is not an allowable expense, then the cash payment that is made in relation to it is equally not deductible for taxation purposes. But we don't have to worry about, firstly, preparing a set of accounts using the normal financial accounting concepts, specifically the accruals concept. We can keep it simple. Who is able to take advantage of this? Available to those businesses here with receipts for a 12-month period, assessable in the tax year, that do not exceed £150,000. Now, this is a big increase, in fact, over what we had in previous years. The figure there used to be geared to the VAT registration limit that is significantly less than that figure. So this year onwards, they've opened up the cash business for many more small businesses there. A trader, of course, may elect for this scheme, opt into it, but then, of course, its levels of cash receipts as the business grows goes above 150. Well, will it be required, therefore, to leave the cash basis? Well, it will, but not immediately. The cash basis, a trader must leave the scheme if receipts assessable in the previous tax year exceeds £300,000. So we've got plenty of scope for growth there before you are required to use the normal accruals concept. The cash basis, as we said, will assess a business on its receipts less its payments of allowable business expenses. We're not going to have to worry from an accruals point of view about payables, receivables, about inventory. Those, of course, would be necessary exercises in a normal accounting statement of profit or loss, but not now for us on the cash basis for taxation. The accounting profit must be adjusted for tax purposes, mostly the same as we do for accruals counting. So again, If there is a non-allowable expense, then it will be disallowed, except that we'll be working on a cash basis rather than on an accruals basis. But we do have one big difference, being in relation to capital expenditure. Now, of course, another problem so far as these traders would be concerned is they don't know and they don't understand about the capital allowances system, how to put that together, what particular assets rank for which reliefs, the problem with private use by proprietors. All of that, again, is complex so far as the small business is concerned. And they will be allowed, therefore, to ignore that, because the rules are expenditure on plant and machinery, which would normally attract capital allowances, will now attract tax relief with capital payments for plant and machinery, except cars. You might know cars again, we're going to be the trouble there, with payments for plant and machinery being deductible and capital receipts from the sale of plant and machinery, again, of course, excluding cars, being included in the calculation of the adjusted trading profit. So if it's just normal plant and machinery, equipment, fixtures and fittings used within the trade, we're still going to work on a cash basis. When you buy it, that is a payment, it is a deduction. When you sell it, any proceeds are taken in as a receipt and they therefore increase the profits. But of course, it's always likely that the small business might still have a car within that business, most usually, of course, used by the proprietor. So what are we going to do there? Well, in respect of cars, instead of claiming capital allowances, the trader may instead use a fixed, or as it's known, flat rate deduction for tax purposes. So the actual cost of the car for when you bought it, any running costs, and then the sales proceeds, all of those are going to be ignored in your profit calculation. You buy an item of plant, that would go in as a normal payment and would achieve tax relief when you pay for it, the cash paid basis. Eventually you sell it, the receipt that you get, that of course is going to be taxable. But not with cars, no. With cars, the trader can instead claim, as a deduction against the trading profit, a mileage allowance for the business mileage. So we're immediately excluding anything that is private, but in relation to business mileage, clearly records will have to be kept of what is allowable business mileage. Then we can put a deduction through against our profits in relation to that. How does it work? The allowances are a rate of 45 pence for each such business mile for the first 10,000 business miles, and then 25 pence per mile thereafter. Now, in fact, these figures are given to you on your rates and allowances pages, not in the context of this, the cash basis, but these figures are again used when, in Chapter 9, we deal with employment income. If an individual is using his or her own car in doing business mileage on behalf of the employer, then these business mileage rates may be used to compensate the individual by the employer without any assessable benefits arising. So we will see these in use in Chapter 9 when we deal with employment income. But here we've got to use them in determining what is the allowable deduction. Now then, the basic calculation, therefore, of the taxable trading profit has become very simple, as we see here. Again, for the accounting period, we pick up the receipts, including the sale of plant and machinery, other than cars. We deduct from it any expenses, payments that we have paid out during the year, including the purchase of plant and machinery. Here, of course, excluding cars. The expense payments also would then include the business mileage allowance in relation to any business mileage done by the individual in his or her own car. And that gives you a tax-adjusted trading profit, or indeed loss figure. So again, a much, much simpler basis. In essence, the main thing that needs to be recorded, any payments going out any receipts coming in. Your basic cash book and bank statement will give you that information, of course, there. You've got your payments, you've got your receipts, and then a record of business mileage. And that is going to allow you to be able to determine the tax-adjusted trading profit. Okay, now we've got a little example here, example 7. I'll talk you through it, and then you can write it up and then check with the model answer in the back. But let's see what we've got. We've got to calculate here Adam's adjusted trading profit for the accounting period ended 31st of May 18. And we've got to do it both ways, using your normal basis, the accruals basis, and then using the cash basis here. So what are we told? Adam commenced trading as a sole trader selling fresh fruit on the 1st of June 17. So there we go, 1718 is again our first tax year of assessment, should we of course have to deal with that assessment. What does this ask us to do? Simply to work the adjusted trading profit for the accounting period ending 31st of May 18. How you then use that would be the normal bases of assessment in opening years. It's just the profit figure is found using a cash basis rather than an accruals basis. Prepared first set of accounts, as we know, to the 31st of May 18, and we have the following information. Right, sales were 61,000. Now, on the normal basis, in calculating profit, you will use sales. But we're then told of which 4,000 was still owed by business customers at the end of the period. So not all of that has been received. So we'll have to take away that 4,000 from the sales figure to get the cash receipts from those sales. Inventory, £1,800 at the end of the period. Irrelevant so far as the cash basis is concerned, but would have to be brought into your normal accounts basis of computing profit to derive your overall cost of sales. Purchases and expenses, all allowable. So again, that exercise has been done for us. There's no disallowable expenses for tax purposes in here, amounted to 29,000. Now those are the purchases, of which 2,000 were still owed to suppliers. So we haven't paid 29,000, we paid 27,000. On the 1st of June 17, Adam purchased equipment for use within the trade, costing £8,000. So £8,000 purchased equipment, it's a payment made during that accounting period. That is another payment to be deducted in deriving your adjusted profit figure. But also, of course, to make life more interesting, a car costing £12,000 with CO2 emissions of 122 grams per kilometre. Adam uses the car 40% for private use, so only 60% business use, and incurred motor expenses during the period of £3,600 in driving a total of 10,000 miles. Now, of course, we don't need all of that information to be able to deal with the cash basis. For the cash basis, we needed to know what the business mileage came to. Well, we've been told that there were, during the period, he drove a total of 10,000 miles. And that we've got here, used the car 40% for private use. So only 60% of those miles, i.e. 6,000 of those miles there, are going to be business miles. Once you've got that figure, it's then back to what we were told up here. What was the business mileage rate? Remember, that will be given on your rates and allowances page. For the first 10,000 business miles, well, 6,000 is within that limit, 45p a mile. And that will form the basis of your allowable deduction there. Using your normal basis, you, of course, have got to put together your capital allowances computation in relation to your plant and machinery and your car. So, let's break this down, therefore. What I want you to do, first of all, is your normal calculation of an accounting profit. Accounting. Bet you weren't expecting that in a tax lecture. So you've got to do your accounting profit, which, of course, given that they're all allowable business expenses, will be the same as that which we'll have for tax. Other than what we've got to do is then compute the capital allowances and deduct those. So I'd like you to work in normal adjusted trading profit using the accruals basis. We know what the sales are. You can work out the cost of sales. You've got your purchases, you've got your closing stock there. You can then work out, of course, your capital allowances that need to be deducted and any motor expenses that need to be deducted as well. Remember, there are two aspects to the normal accrual system. The running expenses, again, the business use proportion will be allowable, and in relation to the cost of the car, then you get your available capital allowance. You have to do your normal capital allowance computation. Do that first of all, and then we need to look at how we deal with the cash basis. Now that again, you should really be able to do. We know what the receipts are, the sales less the closing amount owed. We know what the payments are, the purchases less the closing amount that is owed. We know that stock is irrelevant. And we also know the business mileage, and we know what the business mileage rate is. So you should therefore be able to work that out in relation to the car. And the equipment is ever so easy, it's just what you paid. So I reckon you should be able to have a go at working the answers to this particular problem. Your profit using the accruals basis and then your cash basis. What we'll do, again, I'd suggest you pause at this particular point, and when you come back, what we'll do is to go through that answer together to make sure that you've had no problems with it. Okay, so pause it now and then come back to me once you have dealt with your calculations of these profit figures for this accounting period. Okay, well, let's see how you fared there. For, again, your probably greatest difficulty here for some of you would have been the accounting rather than the tax. The tax bit is the cash basis to begin with. Now, the cash basis, this option that is available here, very clearly the receipts are going to be well under the limit of £150,000 and therefore is available to this particular business. The sales were 61,000, 4,000 was still owed, so the cash receipt 57. Purchases and expenses, purchases 29,000, 2,000 was still owed, payments 27,000 there. The equipment, again, purchase of plant and machinery, normal stuff. Again, all of that will be allowable. The motor expenses, as we saw, what was the total mileage? 10,000. What was the business proportion of that? 60%. That is 6,000 miles. That is within the 10,000 limit for the higher mileage rate of 45 pence to apply. Multiply it through, hopefully done correctly, 2,700. No messing about with business or private use with capital allowances. Bang. What's the business mileage? Should be able to maintain a very easy record of that, times 45p. Had it been 12,000 business miles instead of 10,000, instead of 6,000 rather, then the first 10,000 would be at 45p, and then the remaining 2,000 would be at the lower rate of 25p. Not a difficult calculation. And in that way, we simply and quickly get the adjusted trading profit. Rather more tiresome, of course, using our old accrual system. We know what the sales revenues were, 21. We then need to deduct from that the cost of sales. Now, there was no opening stock, it was a new business that started to trade. So the purchases and expenses were 29,000, and we had an £1,800 closing stock. So we take that away in getting our cost of sales and down to our gross profit. Again, same figure here for accounting and tax purposes. Then, of course, for tax purposes, we'll only allow the business proportion of the motor expenses. Only 60% of the mileage was business, as we've just been discussing. Therefore, 60% of the motor expenses is the allowable figure for tax. Then, of course, capital allowances. No problem with the equipment. It's a full AIA that is available to us here. The £8,000, again, full 100% AIA. The car, of course, is the awkward one. Again, we need to look at what are the CO2 emissions to determine on the cost of the car, that was 12,000, whether it's going to be 8% or 18% based on the CO2 emissions, that is the higher rate of 18%. Of course, given that it has private use by the proprietor, we don't put it into the main pool, we maintain it separately there, and we limit then the allowance to the business use proportion. So our 18% allowance, that of course, although it's an opening period here, if you look at the dates carefully, it is a full 12-month period, which is our opening period. Now, businesses don't always, as we were talking about earlier, start on one day and decide to prepare their accounts to a date exactly 12 months later. But that's what happened here. The opening period was 12 months. So there was no requirement to time apportion that 18% figure. It is a full year. 60% is the business use element. Work that figure through, and therefore you now establish what would be the adjusted trading profit. Again, as you can see here, the adjusted trading profit under the cash basis at 19.3 is significantly lower than that which it would be under the normal basis, indicating at least in that period that we'd be talking about it would be better to use the cash basis. Okay. Hopefully all okay then with the basis of that. Just need to now take you back to the notes again. So if I can get you to turn back to chapter 6 and the cash basis note. Bear with me while I get that here. Here we go. There was the example we've just done. And there's the final little bit and the final example that we need to deal with. Right, let's quickly do it. If you had a trading loss under the cash basis, then there's only one relief available for the trader to carry it forward to set off against the future trading profits of the same trade. Now, we've not yet dealt with the loss reliefs available normally when you use the normal accruals basis. They are detailed in Chapter 7, but they are rather more wide, rather more varied, rather more generous than just carrying it forward. So it does compare unfavourably with the normal loss reliefs that a trader could claim, and that may prove to be a critical issue, especially for new businesses in making the decision as whether to elect for the cash basis to apply, and may also be a reason for the business in future to withdraw the election. Again, if it's loss-making, I suspect, of course, that it won't be in terms of any exam question that you've got to deal with it, then the loss reliefs are less generous. And on that basis, you may favour your normal basis. That said, a final and separate issue that we've got here. You might have some businesses where the premises they're used represent not just business premises, but also the trader's home. Now you might think, well, I wouldn't be living in a factory or something like that. No, but the type of businesses we're talking about, you might have a small hotel or guest house or bed and breakfast or public house where the individual whose business it is lives on those premises. So used as both home and business premises. It's only applicable in this circumstance. So the trader lives in the small hotel, the guest house, the bed and breakfast, the public house there. They live there. Now then, that clearly gives an issue on your normal principle, your normal accruals basis of, there's going to be again an issue about what is business use compared to what is private use. And that, of course, to be able to get all of the expenses correctly documented, are they business, are they private, may involve a lot of work and a lot of maintaining of separate records. So what we've got is this. The individual trader now can elect for a flat rate private use adjustment to apply under the cash basis in respect of the private use of the property for such expenses as. Now, in that type of business, what sort of expenses might there be where we've incurred it both on you, the individual, or individuals? It might be you alone, it might be you and your spouse, you, spouse, kids, whatever, who live in that particular property as well. So we've got an issue here about the extent of the private use on expenses such as food and also heat and light, where there's just one electricity bill for the entire premises. Attempting to compute, therefore, a business private specific expenditure, what we now have is an add back. We, instead of having to work out what are the private use proportions of every one of these individual expenses and have the backup documentation to prove that to HMRC, should they make inquiries as regards our particular accounts, what we can do instead is to pick on just a flat rate private use adjustment, i.e. a flat given rate that is an add back in deriving your tax adjusted trading profit. Now, the relevant flat rates will be, of course, provided in any examination question, and they are based on the number of occupants of the property. For example, if the property had one occupant, a single person running their business, the add back would be £350 per month or part thereof. So 12 times 350, that'll be an add back on an annual basis of £4,200. For two occupants, it would be £500 per month, so £6,000 a year. You don't have to worry about that. The figures will be given to you. All you've got to do is to apply them. The flat rate add back does not include other property expenses such as rent or loan interest payments. Again, if it's not your property, you're paying rent. Again, that is a separate allowable expense. Interest payments, again, you bought the property, you're paying mortgage interest. That again is a totally separate issue. All right, we've got therefore, to finish this off now, and indeed the chapter, example 8. We've got to state how the total cost of food and heat and light may be dealt with for tax purposes and calculate Eve's adjusted trading profit, assuming that the election for the flat rate private use adjustment has indeed been made. So what have we got? Eve, a single lady. Eve, a single lady here, runs a small guest house in which she lives. So she lives on the business premises. Prepares accounts to, that's handy, April the 5th each year. For the year ended the 5th of April 18, she has a trading profit before any private use adjustment. So we haven't added anything back here out of the accounts. All the full expenses have been debited through the accounts. There has been no add back for private use. The total cost for food, heating and lighting charged for this period amounted to £14,000. Again, if we were going with the normal basis here, what we would be doing is to analyse each expense item, business and private, and add back the private part of each. But when, of course, it comes now to dealing with the cash basis, then it's ever so much easier. All we've got to do is pick up the trading profit before any private use adjustment. That was £23,000. Pick up from the question, here it's not stated because I've just given you the information up here. Based on how many occupants, Eve, as we know, is single lady, and therefore there's just the one, then on that basis, £350 a month. We're dealing with the accounting year ended 5th of April, so it's the full 12 months, so that's £4,200 per annum. So on that basis, therefore, we will add back 4,200. So it will be 23,000 plus the 4,200. So what's that? £27,200, therefore, would be our figure of adjusted trading profit. And that means we don't have to worry about the exercise on each expense of dividing between and maintaining the records of documentation for business stroke private use. Now, if we look at the answer to that, well, if you look at the answer to that, what you'll discover again is if you're supposed to use this basis here in any such example, you will be told that quite categorically within your exam question. So you won't have to think, do they want us to do it here? They will tell you that you need to do that. And you'll only see it where the cash basis is in operation. You'll only see it, although in fact this is available to those who do use the normal accruals basis. This will only be involved in our exam paper within the cash basis. Okay, that brings another exciting chapter to an end. We mentioned a moment ago about trading loss reliefs. So now, having worked out what is an adjusted trading profit or loss with the correct deduction of capital allowances, we know how to relate those accounting periods to tax years. What we'll be looking at in Chapter 7 is how, if that outcome is a loss, what are the loss reliefs available? What you know is how to relate the accounting period to the tax year of assessment. And you already know from, indeed, what we did in Chapter 2, that if the trading income figure is a loss, you don't put a bracketed, a negative figure in. That is a loss, so you put a nil assessment. You put a nil assessment because then we separately consider, okay, so what now should we do with that loss? And if you look back to Chapter 2, I think to page 5 of the pro forma income tax computation, you will see either of two places within the income tax computation where losses might and loss reliefs might be allowed to be deducted, either from the trading profit figure at the top of the computation or from our total income figure. We need to put the rules on that to know how and where each of those reliefs apply and be able to determine what out of the choice of available reliefs might be the optimal choice. All of that in Chapter 7.